Why do most people buy at the top and sell at the bottom? Because they don't follow the cycle. They follow the crowd, they see prices going up, and assume they missed out, so they buy. Right when the smart money is quietly exiting, then prices crash, panic sets in, and they sell at a loss, only to watch prices recover later without them. This isn't a mistake, it's a pattern, and it repeats in every market. Stocks, real estate, crypto, gold, it doesn't matter, the crowd always gets it wrong. Now ask yourself, if you had known when the crash was coming, would you have sold earlier? If you had known when the rebound would start, would you have bought faster? That knowledge exists. And the top 1% use it constantly. They don't guess. They read the signs. They follow the economic cycle. They adjust before the headlines catch up. You don't need to predict the future. You just need to understand the present. Because the truth is simple. Money moves in cycles. Wealth moves with it. And if you don't move, you get left behind. But here's the secret the textbooks don't teach. Each economic phase rewards a different asset. And if you know where we are in the cycle, you can stop guessing. You can start positioning. Imagine knowing when to buy real estate, when to get out of stocks, when to hold cash, and when to go all in on commodities. That's not luck. That's timing. That's what real investors do. Buffett, Dalio, Soros. They all follow the cycle. Their portfolios look different. Their strategies sound different, but they all move with the same invisible rhythm. Most people think success is about finding the right stock. It's not. It's about knowing the right time. And that's what you're going to learn, right now, step by step, one phase at a time, so you can move smarter and never feel lost again. Let's begin with the first phase. The one no one wants to talk about, but where real fortunes quietly begin. Recession. Recession is where it all begins. Not with headlines, not with panic, but with silence. The economy slows down, people spend less, businesses make less, layoffs increase, and inflation drops. It's a cold season. Money stops moving, and fear takes over. This is when most people freeze. They hold on to cash, they stop investing, they wait for the storm to pass. But by the time it does, the best opportunities are already gone. During a recession, GDP falls, prices drop, assets lose value. Everything looks like it's going down. And that's true for almost every asset, except two: bonds and cash. Let's start with bonds. When the economy contracts, governments step in, they lower interest rates, they inject money to stimulate demand, and that pushes bond prices up, especially government bonds. Safe, reliable, backed by central banks, while everything else crashes, bonds quietly climb. Look at what happened in 2008. The financial crisis hit. Stocks crashed. Real estate crashed. But government bonds surged. Investors who moved early made a fortune. Then there's cash. Not under the mattress. Not in your checking account, but short-term cash equivalents, like 3 to 6 month treasury bills. They don't offer massive returns, but they don't lose value when markets fall. They protect your capital. They give you flexibility. And in chaos, flexibility is power. Because when prices drop, cash becomes your ticket in. You're not forced to sell. You're ready to buy. This is how the wealthy prepare. They sit in safety, while others panic. Then they strike. They wait for the signs to shift, for the recession to bottom out, and then they move into phase 2, recovery, where real wealth begins to grow, quietly, before anyone notices. Recovery begins before the news reports it, before the economy feels better, before people believe in it again. It starts when GDP begins to rise, but inflation stays low. That's the sweet spot. Businesses slowly come back to life. Factories reopen, hiring resumes, spending creeps up, but consumers still hesitate. They remember the pain, they play it safe. That's why prices remain low. Stores offer discounts. Companies clear inventory. Inflation stays muted. This is the window smart investors wait for. Bond yields flatten. Interest rates have already dropped, so there's little room for bonds to grow. This is when you sell your bonds. They've done their job. Now it's time to rotate into stocks. Not just any stocks. Stocks that survived the crash. Companies with real value, real earnings, real potential. This is when Buffett makes his move. When Ray Dalio shifts from defense to offense. Not during the panic, but during the quiet. Look at 2009. Ford was trading under $2. No one wanted it. Everyone assumed it would fail. By the end of the year, it hit 10. That's a 5 times return. In less than 12 months. This is how recovery works. The world isn't back to normal, but the smart money knows normal is coming, and they get in early. Commodities are still flat, cash is still safe, but stocks begin to climb. Quietly, patiently, before the headlines catch up. This is the moment where risk meets reward. Not at the top, not in the hype, but here. This is when fortunes are built. In silence. During recovery. Before the crowd returns. Before the boom begins. Do you like this personality? Overheat is when the good times start to feel too good. The economy is growing fast. GDP is strong. Inflation starts rising. Everyone is making money, and everyone starts spending it. Businesses expand. Wages climb. Hiring surges. Consumers feel confident. They buy more, and prices begin to soar. This is when demand outpaces supply, when production struggles to keep up, and inflation kicks in hard. Central banks try to cool things down. They raise interest rates. They tighten money supply, but it's often too late. The momentum has taken over. This is the boom before the bust. Stocks reach new highs. Real estate hits record prices. Bitcoin, gold, silver, they all start moving. Everyone looks rich, but that's the warning sign. Because behind the scenes, the smart money starts to exit. Buffett sells stock at peak valuations. Dalio shifts into gold. Soros loads up on inflation hedges. BlackRock buys into Bitcoin ETFs, but they don't say much. They just rebalance quietly. They move into commodities, because when inflation rises, commodities rise faster. Oil, natural gas, copper, steel, wheat, silver. This is the phase where owning real assets matters most. Not paper promises, not hype coins, but things the world actually needs. Look at what Buffett did in Japan. He didn't just buy Japanese stocks, he bought trading companies tied to energy, metals, and industrial materials. Because those are the gears of growth. And in an overheated economy, they spin the fastest. This is not the time to chase overpriced tech stocks or stretched valuations. This is the time to hold what people can't live without: energy, food, raw materials. As prices rise, profit margins shrink, operating costs explode. Only commodity producers thrive. This is the rotation the crowd misses. They stay too long in stocks, they ignore inflation, and they get burned. But those who shift early ride the surge. Before the crash, the warning signs are already flashing. When everything looks perfect, that's when the cycle starts to turn, and the next phase quietly arrives: stagflation, where growth stalls, but prices don't. Stagflation is the most dangerous part of the cycle. It looks like confusion, it feels like frustration, and it breaks the usual rules. GDP starts to fall, but inflation stays high. The economy slows down, but prices keep rising. This is when nothing seems to work. Interest rates stay high, borrowing gets harder, business growth stalls, and yet the cost of everything keeps going up. Wages don't keep up, consumers get squeezed, debt becomes heavier, spending drops, but basic goods still get more expensive. Investors are stuck, stocks become volatile, bonds lose value, real estate slows down, even commodities struggle. It's a slow-motion crash, and it hits every corner of the market. This is when the average person panics. They try to move their money, but every asset feels risky, and nothing feels safe. But there is one thing that holds power in this phase: cash. Not cash sitting in a drawer. Cash in the form of short-term government debt, 3-month or 6-month treasury bills. Liquid, stable, and still earning interest. This is why Buffett parks billions in short-term treasuries. He's not waiting because he's scared. He's waiting because he's ready. Ready to strike when assets get dumped, when the weak hands give up, and everything goes on sale. Cash is power in stagflation, because everything else breaks down. And those holding cash decide what gets picked up. This is when wealth transfers, from those who panic to those who wait, from the over-leveraged to the liquid. The world complains about inflation. Governments debate rate cuts. Central banks hesitate. But the clock keeps ticking, and those with a map, those who understand the cycle, they're already preparing for the next shift. Because stagflation doesn't last forever. It leads back to recession. And that's when the real buying begins again. If you're holding the right hand and sitting on the right pile, cash. You don't need a degree to understand economic cycles. You only need 2 numbers: GDP and inflation. That's the real map, the hidden guide most people never learn to read. If GDP is falling and inflation is falling, you're in a recession. If GDP is rising and inflation stays low, you're in recovery. If GDP and inflation both rise, you're in overheat. If GDP falls but inflation stays high, you're in stagflation. That's the cycle. Simple. 4 boxes, 4 signals. Now think about it. If you know which box you're in, you know what to buy, what to sell, and when to wait. You don't need predictions. You don't need perfect timing. You just need awareness. This is how the top investors move. BlackRock doesn't guess. They measure. Ray Dalio doesn't hope. He watches the cycle. Buffett doesn't chase trends. He reads the timing. Different names. Same method. They follow the same current. They shift assets based on signals, not emotions. This is the secret, hidden in plain sight. And the reason most people never build wealth is because they never learn this cycle. They buy stocks in stagflation. They sell bonds in recovery. They hold cash during overheat. They chase real estate at the top. They always move late because they don't see the signs. But if you learn to read GDP and inflation, you move first, quietly, before the crowd. This is how the game is played. This is how the wealth flows. And this is how you win without guessing, by following the real blueprint, the one you were never taught, but always needed. So where are we now? Look at the numbers. In 2025, US GDP growth is slowing, but inflation is still sticking around. Prices for essentials keep rising. Jobs are shrinking. Wages are lagging. And the cost of borrowing stays high. That's stagflation. Not theory. Reality. The markets are uneasy. Stocks look unstable. Bonds aren't recovering. Real estate feels inflated. And yet the grocery bill keeps going up. We're watching the economy cool down. While prices remain hot, that's the transition zone. From overheat to stagflation. It's already happening. And it's global. Look at Argentina. Look at tech layoffs. Look at commodity spikes. This isn't a soft landing. It's a signal. So what should you be doing now? Not chasing stocks. Not locking into long bonds. And not hoarding overpriced assets. Right now is the time to hold cash. Not in a checking account. In short-term government securities. 3-month or 6-month T-bills. Safe, liquid, and still earning yield. That's what major players are doing. That's what Buffett's doing. Holding short-term treasuries, waiting, watching, ready to buy when assets crash. Also consider shifting away from dollar-based assets. If the dollar drops, your dollar assets drop with it. Explore stronger currencies, or hard assets that don't rely on dollar strength. Positioning matters more than picking, because when the next cycle starts, the cash you held becomes the weapon you use to buy what everyone else is forced to sell. This is the calm before the storm. The part where patience pays off, and liquidity becomes your greatest edge. If you're sitting on the right side of the table, you won't need to panic. You'll be ready. Timing isn't about luck, it's about rhythm. Each phase has its winners and its losers. You just have to match the asset to the cycle. Here's a simple guide. In recession, hold government bonds and cash. Don't chase risk, wait for opportunity. In recovery, move into stocks. Sell bonds once yields flatten. Focus on undervalued companies with strong fundamentals. In overheat, rotate into commodities. Oil, gas, copper, wheat, and silver. These respond fastest to inflation. Real assets outperform paper ones. In stagflation, return to cash. Short-term treasury bills. Hold liquidity, and prepare to buy assets cheap when the crash hits. This cycle repeats, again and again. You don't need to beat the market, you just need to be aligned with it. If you have $1,000, use it to stay flexible. Wait for the right window. Don't rush. If you have $10,000, divide it. Keep a portion liquid. Put the rest into inflation-resistant assets during overheat. If you have $100,000, use the full cycle. Rotate between bonds, stocks, commodities, and cash. As the signals change, diversification isn't just about different sectors, it's about different cycles. Owning stocks and bonds isn't true diversification if they both collapse in stagflation. That's what happened in 2022 and 2023. Global markets dropped across the board, and many balanced portfolios got crushed. You need real hedges, assets that move differently, at different times, for different reasons. That's what cycle-based investing gives you. Protection when others are exposed. Leverage when others hesitate. You don't need to be perfect, you just need to be early, because when the crash hits, it's already too late to reposition. The winners already moved, the game already shifted, and those who stayed flexible will be the ones holding the cards when everyone else is selling theirs. Silver is the forgotten metal, quiet, overlooked, and massively underpriced. Most people talk about gold. It's shiny, it's famous, it's the headline metal. But silver is the one that moves faster. It lags gold during the early part of a cycle. But when it catches up, it often explodes. Right now, the gold to silver ratio is stretched. Historically, 1 ounce of gold buys 50 to 60 ounces of silver. Today, it buys over 90. That's a signal. It means silver is cheap, historically cheap, and likely ready to move. Now add this. Silver isn't just a safe haven, it's also industrial. Used in solar panels, used in electric vehicles, used in medical devices, used in semiconductors. As demand for clean energy rises, so does the need for silver. But supply isn't keeping up. Since 2015, global silver production has declined. Mines are drying up, and new ones are hard to open. At the same time, usage is increasing, especially in countries like China, where solar expansion is massive. The result? A supply-demand crunch. More buyers, less supply. This is not a maybe, it's already happening. In 2024 alone, the silver deficit hit over 5,000 tons. That's not a dip. That's a structural shortage, and when shortages meet rising demand, prices jump. Silver has been consolidating, moving sideways, staying quiet, but now it's breaking out, crossing resistance levels, attracting capital. Smart money is rotating into silver, quietly, before it gets crowded. That's how cycle investing works. You move before the crowd, you position when things are boring, and you profit when things explode. If gold is the headline, silver is the hidden chapter, and that chapter may be starting now. You've just learned what most people never will: how to read the cycle, how to move before the market moves, and how to protect your wealth when others lose theirs. This isn't about timing the market perfectly, it's about understanding the rhythm, recognizing the signals, and adjusting with confidence. Most investors guess. Now you don't have to. You have the map. Use it. Stay patient during recessions. Get aggressive during recovery. Hold real assets during overheat. And protect your capital during stagflation. This is how wealth is transferred. Quietly, from those who don't prepare to those who do. If this helped you, like the video. Subscribe to the channel. Leave a comment about where you think we are in the cycle, and share this with someone you care about. Someone who needs to hear this before the next shift hits. Here on The Passive Path, we break it down so you can build it up, your time, your choices, your future. Feel free to check out other videos on the channel. Each one gives you the edge the system never taught. Good luck with your journey. Stay focused. Stay ready. See you in the next video.